So we navigate the multifamily market. We see that kind of the end of 2026, there's a little bit more clarity. Supply should be at much lower levels, and inflation should be a little bit more tame, and maybe interest rates, well, maybe they're where they are today, maybe they're a little bit lower. But what happens from today, at the end of 2024, throughout next year of 2025, and really kind of the first half, or maybe even the whole year of 2026? What happens between now and then? That's the big question that multifamily investors, owners, everyone in the industry is asking. And fortunately today on the Gray Report, we've got one of the, if not the best, transaction multifamily analysts in the country joining us. Gray Capital's own Jay Reeder, Chief Investment Officer at Gray Capital. We're going to be digging into all kinds of articles, great slate that Dr. Bosnagel's put together for us. First, we're going to be getting into an article from RealPage talking about supply. We're going to be getting into the fundamentals from Apartment List, looking at some of the geographical differences for builders from the National Association of Home Builders, a little bit of information from Moody's Analytics on affordability concerns, and then from the Harvard Joint Center for Housing Studies, a little bit more on housing affordability. All of that and more. You're going to want to stick around for the full episode. Make sure to like this video, subscribe to the Gray Capital YouTube channel. Let's get into it. Welcome back to the Gray Report. Jay Reeder, how we doing, Jay?
Doing well. Thank you for that wonderful introduction.
You bet. Well, I've been excited because you've hopped in as a guest a couple times on the Gray Report, but it's usually when I've been out of town, and you're sitting in with Dr. Bosnagel, and so this is great that we get to sit together. We could talk about deals pretty much all day, every day, and so I think for the audience watching the Gray Report, this is going to be a treat. Maybe get a little bit of sample of how maybe we talk about deals, how we look at deals, how we analyze deals in the context of what's going on in the market. So before we get into these articles, and we're gonna touch all of them just maybe a little bit, but again, much more interested in just kind of having a conversation about like the market right now, what we're seeing, how you're kind of envisioning deals, and how to thread that needle to, one, take advantage of maybe some opportunities in the market because of some good basis, but the reality of, we're kind of in this slog of, low, no rent growth, a ton of supply right now, but like we see some there's a ton of glimmering light down there at the end of the tunnel that's like not that far away. So like, just how do you feel about the multifamily market, the acquisition space today?
I mean, like you said, I think I'm full of mixed emotions when it comes to it. And it's like, you and I have this discussion all the time when it comes to what I like, what I look for when I look at a deal, but we have to look at it from a lot of different ways. There's the idea of liking a deal, liking the basis, liking the bones of it, liking the location. I mean, the old saying, like, location is everything in real estate. And we have to find that. But then on the flip side, as we're talking to people, as we're getting our investors excited about the deal, what's the story behind why they should be excited? Because sometimes the story doesn't necessarily reflect the numbers.
Yeah.
Or how do we balance that? Because I think for people that haven't gotten to sit on the inside and have the conversations you and I have had, it's like, I know there's a lot of deals that I've loved, and there's a good story behind why I've loved the deal. I've been right on some of those, I've been wrong on some of those, but for whatever reason, we can't translate that like to what our investors would be excited about, or what they envision kind of working with us, is because we have a little bit different niche than other people do. We're in the Midwest. We kind of have this market that's a good combination of yield and appreciation, whereas people that are used to, as we've talked to, like people who only invest in New York or LA, it's like, well, I don't really care about cash flow. No one that invests in those cares about cash flow.
They're just focused on appreciation.
They're focused on appreciation. Yeah. And we have people that kind of need a little bit of both. Mm-hmm. And so I have to look at deals maybe a little bit differently than someone that's looking to invest somewhere like in New York and LA and Miami. And so we have those conversations of great location, but it's not the cash flow that we need for our investors.
Yeah. And so like what you're describing is, we'll have an investor that you'll have a conversation with, and they're like, I'd love to buy, a newer construction, fast growing suburb in the Midwest. I'll accept slightly lower cash flow, but like, I want to get that, really good location. And we're like, okay, we can go ahead and try to find that. And because we like that too. And then great location, confident. We say this all the time. We know that the value is going to be significantly more in 5 years, in 10 years. Like just with an incredible amount of confidence, given the trajectory of growth in that market, just the stable economy, knowing about the supply coming online or the lack of supply over the next couple of years. But you still comes down to the math and the numbers. And then we look at kind of either whether it's cash flow, and sometimes it's total return and IRR, but often, we're first cash flow investors. And so we look at the cash on cash, and
3% doesn't excite anyone.
Well, and sometimes it's not even 3%. Sometimes it's, 0%, 1%, 2%. And, coming from a world where, pre-pandemic, we were targeting 8%. And maybe even if you were on a bridge loan with IO the first year, double 10%. Yeah. I mean, most of the deals for a while back, like 2016, 2017. Now, some of the assumptions, and this is like when I was investing as either an LP or a co-GP, but it was, if there wasn't like 10 or 11% cash on cash year one, and then, you buy it on a bridge loan, and you put it on a 223F or an agency loan, and it dip back down to, 8-9%. But like, you're averaging basically 9 or 10% over the first 2 years. Whereas that's changed as cap rates compressed and, interest rates have gone up and down. But where cash flow, okay, maybe we can expect closer to like 7%. And now then it was like 6%. And now, so to us, it's like, man, we at least want to see close to 5 or 6. Really, we want to see 6. But the greatest deals in the best locations
just aren't going to have that.
They're just not going to have that. And there's not a lot to project for growth over the next 18 months or so.
No, and I think that's the hard part, because you and I have had this conversation now for going on 5 years. I know we have to talk about it. I know that that's the metric that people look at. I hate IRR, because especially these deals where we're not going to see a lot of growth for 2-3 years. If I have no cash flow for 2 years, that kills my IRR, because that backloads all of my return. And so it's a deal, like if we look at an equity multiple, there was a deal I was looking at a couple days ago where I think it was like a 5 or 7 year hold. I was kind of in the 2.3, 2.5 equity multiple, which is kind of what we shoot for. I know we kind of always talk double at 5, 2.5 at 7, 3 at 10, roughly. But I was like a 12 IRR because it was all backloaded, because there was just no cash flow.
Yeah. What are some of the metrics that you're looking at when you're analyzing a deal? What are some, whether you've always looked at, or metrics that you've started looking at more last year or so?
I really think the biggest one for me, and I know you and I talk about it a lot, is some people call it like gross rent multiplier. Some people kind of call it like, it's kind of a basis calculation. I just kind of call it 1% rule, because I learned about it like from people that kind of did single family investments, and it was kind of a big metric in the kind of single family rental.
Classic back of the napkin.
Exactly. Method, it's like, okay, is the rent you're getting 1% of the per door purchase price that you're doing? And we're never going to be at 1%. Like we're never at 1%.
Institutional multifamily in a competitive market. Yeah.
Yeah. So I call it the 1% rule because that's kind of the old metric, but it's the same calculation. We're never there. It's like those deals
how close to 1, and then relative to kind of other deals we've done. For example, okay, well, we were at 0.8 or 0.85.
Exactly.
Is it close to a deal that's been
and
successful?
Then I kind of do the same thing on the back end for like a gut check for us. Like when we go to do our exit sensitivity, am I exiting at a similar ratio?
Yeah.
So that way, if someone's looking at the investment the way I am, I'm not over assuming my exit.
Well, what's the I guess the range on, if you're looking at 1% rule? What would be like too low where you're like, definitely not, this is over the skis? And what's
So I think my general range is about 0.7 to 0.8.
Okay.
I think the deals that we've had the most success on, and I've gone back and kind of benchmarked a lot of our deals that we've done, have kind of been in that 0.7 to 0.75 to 0.8 range.
Yeah.
But I think working deals pencil down to about 0.7. But I mean, there were periods of time, kind of 2021, 2022, where stuff was going for like 0.5, 0.6. And so we're kind of seeing it come back. And I think for me, I never really necessarily need to like exit the exact same as what I entered as, but I need to be kind of within 5 to 10 basis points of like, if I come in at 0.75, I'm not being much more aggressive on my exit than maybe like a 0.65, 0.7. But also like, I know that right now there's some intricacies in the market that maybe I'm gonna be a little heavier on that. So understand that probably that real number is closer to 0.7. And I think the interest rate environment is kind of why I'm pushing up maybe closer to that 0.8.
Okay.
And I really think, because when I really started looking at this metric kind of in the late 2020, early 2021, that 0.7 was kind of my line of demarcation. And I've moved because of interest rates and needing to have a little bit more income to cover the growth in interest rates. I've come closer to the kind of 0.75 range. I think like when we just closed Solana, I think Solana on our purchase price, we were at like 0.86, and our all-in cost, since we had some value add component, I think we were at like 0.78.
Yeah,
on that one.
I think some of those simpler, very easy to calculate metrics are a really good gut check. Whether it's at the beginning or like even near the end of an analysis, because when you jump into the model and that there's so many variables that you can adjust, you can go down a rabbit hole of creating something that may be a little bit detached from reality. And at the end of the day, kind of zooming out and like kind of generally where are we with this deal?
Yeah, and I think it's obviously it's an imperfect kind of ratio, because it's kind of for that middle of the road. Obviously, if you're looking at kind of like a class B or a class C, you're going to be much closer to 1%. But then when you look at your income expense ratio, you're going to be much closer to 2 or maybe even sub 2 on an income expense ratio. Yeah. And so then all of a sudden my 1% rule kind of falls apart, because it doesn't matter what basis I'm buying at as a percentage of income, because my expenses are such a large percentage of my.
And are you looking at the rents on like a trailing basis, or are you looking at pro forma? Both?
Usually what we do is we kind of do a gut check initially of like, okay, what are they as kind of like today?
Yeah.
And then kind of from there,
rent roll today.
Rent roll today. Average rent and today. Then it's like, okay, we're projecting out the rent roll at like when we take it over.
Yeah.
And it's like, okay,
90 days.
Over in 90 days, it might be, it's marginal a little bit. And then it's like, okay, what does year one look like? Mm-hmm. And like, what is our year one? And those are kind of the stages. I would say the first one we really look at is like, what is it today? Because projections we all know that like it's what we think is going to happen, but we don't know. And it's when I'm looking at those numbers, I really want to know, what is it today?
Got it. What are some other metrics?
I mean, income expense ratio is another one. Some people kind of like, will say it in different ways. Like, I know for me, the big one for me, kind of when I was kind of coming up in the industry, was the income expense ratio. I looked at it as like, what is my rent over my expenses? Some people look at it as what percentage over your expenses of your rent. So like some people will say it's like, call it 35 to 45%. I kind of look at it more as like a whole number. Is it like 2% is my income double my expenses? And the reason I always kind of looked at it that way is it was a real easy number for me to look at. And when I was trending income and expenses, again, I'm calling 10 years ago, and it's like, okay, we're looking at 2% rent growth, 2% inflate, or 2% expense growth, 3% income. And I needed that ratio, because if I didn't keep that ratio and it wasn't above 2%, there was a point at which my income outpaced my expense growth outpaced my income growth. And then I would dip below 2. And so I wasn't appreciating the asset, I was depreciating the asset. Yeah. And so I also worked in like workforce housing. And so those ratios were a lot closer. And so maybe you couldn't push rents as much. Yeah. And so that's where that metric always came for me, was it's like, I need to make sure that I have an expense ratio that whatever my growth is, my income is always going to outpace my expenses. Because if we don't, I'm depreciating the asset moving forward.
Yeah. So you used to work for Gene B. Glitco, big apartment developer and owner here in Indianapolis. It's market rate, but big affordable portfolio, big kind of nonprofit wing. What are some of the, I'm just curious, what are some of the differences, working in the, affordable sector with a little bit of market rate, company that had been around since the 60s, a ton of history, very like institutionalized, compared to working in, you were employee number one at Great Capital. So, like pure, startup scenario, multifamily syndication, raising money, going after market rate deals. What are some of those differences?
There's a lot of differences. Obviously, the easy one is like one's been around forever and has the systems and everything. We kind of had to build our systems kind of from the ground up. But I think kind of even going further, I think it's like, what's the driver of the business? Because that portfolio was over 120 properties. It was all over the country. I think when I left, we were in like 14 states or something like that, over 20,000 units. and we were growing, but we weren't really growing on like the market rate side. They were a huge developer back, like you said, in the 60s, 70s, and 80s, and had developed a lot of stuff. Some of the development was market rate, some of the development was affordable. Some of the development was affordable that once like the affordability restrictions burned off with whatever debt they put on, they converted to market rate, but it was a much older portfolio. And so we kind of operated those ones. The working with investors was different. We had investors in those deals, but they were very, very passive, because at the time those people didn't invest for cash flow. They invested for losses back in the 60s, 70s, and 80s.
Tell us a little bit more about that, because it's so different from the way people invest in real estate.
It was, and I got a little bit of a glimpse of it because I started there in 2013.
Okay, yeah.
And so I kind of came in as kind of this syndication space was now starting to expand. And so we weren't bringing on new investors, but I had to correspond with existing investors. And basically those were set up a long time ago where like the investors didn't really care. They invested for the losses. They worked with like,
purely tax purposes.
It was almost purely tax purposes. And like
what type of people were the investors at that point?
They were all over the country. They had
like
individuals, high net worth individuals, but a lot of I think there was like a financial firm out of Boston or something like that they had teamed up with early on, and they worked with these people. And we had over 2,000 investors all over the country.
And so you're dealing with their estates at this point?
A lot of them it was. And maybe it wasn't even, some of them were estates.
And they've been in the deal for 40 years.
Yeah, at that point, some of them were close to 50. Oh, wow. And
talk about owning forever. Yeah. I mean, you hear that a lot, and that doesn't always happen.
And what's funny is you can always tell which ones it were, because most of the deals when they were done were like 12 investors, like 12 to 20 investors. It was pretty minimal. But then you would see these all of a sudden like 40 investor ones, and like you would see these like things where it was like 0.333 of a share. It's like, oh, that person passed away and split it three times to their kids. Like, so you had all these, and the big thing with it is like, there usually wasn't a lot of pushback from investors because they were like second generation, sometimes even third generation of the original investors out there. And so they were just happy getting a check once a year.
Yeah.
Like they had no desire.
Unless they were trying to liquidate.
Yeah. There was no need, hey, I need to get my capital back. It was like, hey, I'm getting my check once a year.
Yeah.
I have nothing, no skin in it. Where's my tax? Where's my K1? Where's my check?
Yeah.
Because we only did distributions once a year. So like I know here we do monthly, quarterly, depending on the deal.
It's a little different.
We did it once a year. It was March of every year.
It's a bigger distribution.
Yeah, much bigger distribution. It was, they got their check, their K1, and a lot of those deals were on HUD loans, so they would get a copy of their audit. And like they just got a packet, and that got sent out March every year. The lady who handled all that stuff, she sat next to me at the office, and like that month, like there were boxes and file folders of copies of audits and
all physical
copies. The
physical
accounting was physical check, dropping it in the folder. And so she would bring her, like on the weekend, she'd come in and her daughter would like be sitting there like stuffing all the like audits in all of the folders, and then she'd like bring it over to her, and then like she'd be the one like stuffs all the checks in there, and accounting would come like every couple hours and bring like the next batch of checks over to us.
Nice.
But so that was like the old investments. But when I was there and I was working on the acquisitions and I was looking at deals, was for the nonprofit. So like I said, they weren't really building a lot of new stuff. They had one like joint venture that ended up being like our office that we worked in, but almost all of the acquisitions were for the nonprofit housing foundation. So Mr. Glick, who founded the company, had passed away actually like a month before I started working for the company. But it had previously, probably a year and a half before that, transitioned to kind of like the family doing the succession plan and different people taking over the business. But we were looking at definitely affordable properties. And that was a very mission-driven organization of like, the mission was to provide affordable quality housing for people who need it, basically. I used to have the whole like 2-sentence spiel memorized, but that's probably 80% of it there. It was they just wanted to preserve and for affordable housing. And so when I'm looking at deals, I was actually looking, a lot of the deals I was looking at was tax credit deals that were coming out of compliance. And we were trying to keep them as affordable housing.
You're trying to maintain them in that affordability pool,
rather than people that were trying to buy them and mark them up to market rate. And so my metric was I had to get a 1% return.
Cash on cash?
1% total return. because they needed to break
positive.
even.
It needed to be positive.
It needed to be positive. And basically, the reason it was 1% and not break even is we needed a margin of safety of like if something were to go wrong and like we had some assumptions wrong that like we weren't eating too much into it. But since it was such a goal to preserve the affordable housing, we were paying up on deals that were going to go market rate. And then because they were out of tax credit compliance or because they didn't have HUD loans anymore, we were offered operated under safe harbor, which is basically how nonprofits can own affordable housing. Mm-hmm. And basically there's a set aside where you have to have so much of the property at like 60%, so much of the property at 80% AMI, and then you can have a handful of units at market.
Yeah.
And so anything that we bought that wasn't tax credit was under safe harbor.
Do you have to pay property taxes if you're in the safe harbor?
So we were able to, in certain markets, we were able to apply for tax exemption because we were owned by a nonprofit. Mm-hmm. Some municipalities were great about it. Some were not. So that was very, very municipality driven of where we were. We could get real estate taxes waived. So that was usually when we underwrote it assuming we had to pay the full boat of taxes just because we didn't know when we walked in. We had a pretty good idea depending on the market whether we'd get the abatement or not, but we didn't know, so we always had to underwrite. So a lot of times if a deal did cash flow, the cash flow at the deal was because we didn't have to pay property taxes.
Makes sense. And the beneficial part, from my understanding, to the company is, one, I mean, you're pursuing this really beneficial mission for the community.
And it was a bucket of money that could be used for nothing else.
Yeah, it's already been set aside. But then you're still able to charge, fees, property management fees that can still feed the beast and keep, pursuing the mission, but also grow, keep the lights on, and able to charge fees that maybe a little bit above market.
Yeah, I think when we started going there, it was, I think the rule was like, you could do it HUD approves, or there was kind of a set aside of it. And it was basically, I remember every year we'd have to kind of go through and do a market study of like what market rates were for that, because with how it was set up, we bought stuff for the Housing Foundation, but there were a lot of kind of similar people involved. And so to keep it like arm's length, we had to have some third party reports. So we'd have to go to the market and say, okay, what are market rate, property management fees, like what can we justify here? And then we had to every year kind of present it to the board of like, okay, this is this year's approved amounts.
Well, you can see that we're just pulling up this article from the Harvard Joint Center for Housing Studies, taking a look at number of cost burden households. It looks like it reached another record high in 2023. So assuming that we've got a kind of a similar outlook for 2024. And so this is where affordable housing is going to play, a key role, going to continue playing a key role. Housing and affordable housing was a major campaign topic for both the Trump campaign as well as the Harris campaign. And so it'll be interesting how, if any, that housing policy kind of unravels itself. Obviously, probably a little bit of different approaches, more focused on deregulation on the Trump side rather than throwing probably some more money at it that the Democrats are maybe going to do. Curious just on that. I mean, have any insights on housing policy and any difference kind of post-election? I believe that they announced the proposed new Secretary of Housing and Urban Development. Let me pull this up real quick. Scott Turner has been picked for the Secretary of HUD, and I'm just dropping this on you, Jay. We didn't talk about this at all.
No, you're fine.
Beforehand. But we had been talking about what changes could happen at HUD. I mean, there's conversations back to, and I actually just talked to Leslie or Les Shaver just a couple weeks ago, talking about changes at Fannie and Freddie potentially. What do you think is going to happen now that we're going to have a Trump administration? I think we're more confident that we'll have a better kind of a tax regime, but specifically with housing policy, HUD. I mean, opportunity zones, GSEs. Any insights and thoughts just initially, or something that you're at least like looking out for over the next year or so as things develop?
I'd be real curious as to like what the incentives are to have affordable housing. Like I said, kind of wrapping up my time at Glig before I came here, they were pushing pretty hard into the tax credit space. Mm-hmm. And the tax credit space has probably been the most successful opportunity to provide affordable housing. With that said, it still has its heavy limitations. I mean, there's a whole history for anyone that wants to go out there about the solutions for affordable housing they've had. I mean, the one probably everyone knows the best are Section 8. I mean, because everyone kind of throws that out there. It was an okay policy. I mean, owners and developers, I think that one gave a lot of support to owners and developers, but it probably wasn't the best for the administration. I mean, it's basically the government's paying someone's rent for however long. So that money has to come from somewhere. And so it still works to this day because those owners have that contract and that guaranteed income of someone coming in. So they're able to keep the lights on. They're able to make the payments and do the things that they would do.
If the local organization pays, we're talking to you, IHA.
That's vouchers though. That's not Section 8.
That's different.
I mean, it goes project-based Section 8 versus vouchers.
Yeah.
And so there's a whole lot of intricacies in that, but exactly, the money has to come from somewhere. And they have these 5-year, 10-year, 20-year contracts when you do it. And the government, when you sign that 20-year contract, pulls the money aside for 5 years. And then basically, what your OCAF adjustment is going to be basically for the next 5 years. You're going to have I think it's 2% or OCAF, whatever it's going to be for 5 years. And then they do a market study every 5 years and you can mark up and mark down. There's kind of all these things you do. But at some point, maybe that money runs out. And so then all of a sudden you have these properties that are low income and may not be able to cover the expenses. If that guaranteed, because a lot of Section 8, they're assuming their operations on 98% occupancy. Because it's someone moves out, 5-day turn, get another person in there. You have a wait list.
Yeah, that's true. Yeah,
they're operating as though there's someone that's going to be in there. When it flipped to tax credit provided either new or newly renovated affordable units to people. And I think there's two shortcomings I always had with tax credits. While I still think it was the best option available, it still is a struggle. When you're looking at new tax credits, when you're trying to develop them, it's a point-based system. You get points for your project and then you get approved and then you get the tax credits to fund your deal. There's a line of demarcation where after developing so many units, you don't get points for more units. And so when you look at these units, they have to be 50 to 75 units to get it done.
Yeah.
And if you want to do it at scale, you have to phase the project and treat each phase as though it's a different entity.
Which from a management perspective is
a management headache.
Yeah. You don't want to manage a 50 unit project.
Or when you're submitting to try to get your credits, maybe you get one of those approved, or you have to phase it in over years where it's you have to do one phase every year to assure that you're going to get enough credits each year to get the deal done.
Yeah.
And if you don't get the credits, you can't do that phase.
Wow.
And so it really limits the amount of affordable housing that someone can do. Someone can't drop a 200 unit affordable deal like you can 200 to 300 unit market rate. That's why you see almost every Section 8 deal that we had was 100 to 150 units.
Yeah.
Almost all the tax credit, new ones that you see are 50 to 75. The one area that you can get some more scale is if you do a 4% versus a 9% and you're renovating a market rate and making it affordable, but you have to find a market rate that someone hasn't jacked the rents up to max rents already. And then you have to put enough money into it to make it livable. And that's just harder to pencil right now because everyone's grown rents so much the last few years that the ability to renovate the unit and still grow rents is difficult. And that's about the only way you can do it at scale, but it's harder for those deals to pencil right now.
So, I mean, that sounds like a pretty clear area that, reform could be beneficial because again, the reason why we don't look at properties, really sub 150 units and really want to see 200, 250 is because of the economies of scale. And it's a challenge to staff and manage a property that's 50 units. Typically thinking about, one person per 50 units and one person, you
can't lease,
and you can't fix stuff. It's probably too much. Maybe one, you have one guy is basically you can have a maintenance tech.
Yeah. And a lot of times if you do the redevelopments, the 4% redevelopments, you have that scale. But what happens is the way that you have to do it. And I think you've heard the stories of this, someone spends $40,000 on a monument sign because you have to spend the money to upgrade the property.
Oh yeah.
But you spend all that money up front and then you have to basically budget spending zero money, $100 a unit for the next 15 years on your CapEx.
It's frustrating because you do see the money has to be spent because it's you use it or lose it, and so they're looking for projects to do. And I've heard stories of the $40,000-$50,000 monument sign is literally just we have to spend this money, but then no money goes into maintaining the property.
And so then when you go to buy that property, in 15 years when it's coming out of its initial compliance and the GP's trying to get out, the property's been run to the ground. There's shingles missing. Yeah, shingles are 20 years, but they didn't have money to upkeep like the one roof where like 4 shingles blew off of it. Like siding's coming down because like you couldn't afford to re-side the side of a building.
Yeah. And so this is where, buyers, when they see, it's a 2005 built asset and it's getting ready to come out of,
It's like, 2005 vintage.
Oh, yeah, that's a relatively newer property, shouldn't have to do too much, core plus. And then you get into it and it's like, this whole place needs to have a full value add. This thing looks like it appears that it looks like it was built in like the 80s or the 70s, and we're going to have to put that much money into it just to get it back up to level, not to mention
the stigma the property has had for 15 years.
Current, you may not have like the best, demographics and resident pool there. It's a true reposition, which can be easier said than done. But, sometimes brokers don't highlight that fact as much. And you're like, 2005 vintage, it's great.
Yeah,
it's drops down the street.
And so like I love the idea of providing affordable housing. Like having worked in that company for that long, like that mission was heavily like pushed into us, and it forced how we ran business. I mean, even on kind of some of the legacy stuff, like they overprotected the asset because they knew what happened when stuff didn't, and like
it is an incredible legacy. I mean, you go to it when Glick sells a property, which is pretty rare, but it happens
rarely. But yeah, it did happen.
I've been able to be an LP on one Glick transaction, Woodbridge up in Fort Wayne, and the brokers always say it's like we owe Glick, they have huge payroll, so they're like you can cut a lot of the expenses, because they take care of the property.
I mean, I remember at the time when we were underwriting. So I've been here about 5 years. I was underwriting up until 5 years ago, and at the time, this is 2019. And I think, man, I think my payroll at the time was like $1,400-1,500 a unit. And like I'd get a broker package and it's like $900 a unit on payroll. And I had this whole matrix that I went through with our HR department. And they're like, well, here's our 75% quartile. Here's our 50% quartile. Here's our 25% quartile. Here's 100 units. Here's 150. Here's 200 units. And so it's like, I just have to circle the median for whatever size I was in. And then if it was a market that we had, like we had some stuff in Virginia. So obviously Virginia was a little bit more expensive than here. So like there were like markups for cost of living that I would have to do on some of the things. And that was kind of how I did. And every time I did it, it was like I had to pay that. And then it's 25% payroll because they had very robust benefits package. And so like anything I did on payroll, I had to like add 25% for benefits. And so I was total payroll burden. I was probably $1,400-1,500 a unit at that time. And I mean, right now we sit talking people under it. Man, we're at $1,500 a unit. When I remember when I started working with you, we underwrote our first handful of deals between $900 and $1,100 a unit on payroll. And we weren't off base at the time.
No, I've seen performance with Les a couple of years ago. The other cool thing I think about Glick is just the legacy that they were able to leave. I mean, between the foundation and supporting affordable housing, but of all of the philanthropic work that they've done. I mean, I think it's a true incredible example of multifamily owners in the industry, giving back to the community. I mean, I think about all the, the community the Glick community centers that are out there, the
Heritage Trail,
the whole cultural trail, which has been a game changer for the city and has connected different neighborhoods. It's a very inspiring legacy, and to see, to have an example of that kind of full cycle starting in the 60s that's continuing today.
And I mean, even like one of the things that they used to do that mattered to the company, it was every year we did like a day of service. They did like day of service, and we actually like did multiple each year, because one of the things we did every spring was we did the cultural trail. We went and did the cleanup on the cultural trail, because like with the Glicks haven't provided for it. They
got the name on it. Got to look good.
So we did like a lot of the planting. Like we would always have a section of it that we did like the cleanup and the planting and all that every year. But then we'd also do like when the city does in the fall, the day of caring, we always would do stuff. We went to like, is it the Girl Scout camp over on the west side? We did some stuff there. We repainted the YMCA just up the road here off of Keystone one year. So did a bunch of stuff with that. But then on top of all of that, every person was given 8 hours of community service PTO every year.
Oh, nice.
And so like you could go do a day of service just on your own. If there was an organization that mattered to you that you wanted to give a day to, you could do that.
That's great.
And then one of the last years I was there was the 70th anniversary of the company, or 75th anniversary. I saw both of them, so I think it must have been the 75th anniversary. What they did is they gave every employee in the company $75 to donate to whatever they wanted to.
That's cool.
And so it was some of the things like that, not just providing the housing, but doing
having that culture of giving back.
Yeah,
that's really cool. Okay, well, let's pivot just a little bit. No, I think it's such a good story, and I wanted to dig into it. I wanted to just shift to talking about supply, because supply is the major theme. We're getting past, for multifamily, we're getting past kind of peak 50-year supply in the market. This piece from RealPage, penned by a friend of the show, Carl Whitaker, really looking at some when will apartment supply peak in given markets, and then also what does that peak inventory growth look like? It is around 1%, which is basically nothing, or is it over 5%, which you can start to see some kind of issues, and depending on what the demand is, some negative rent growth. Now there's some markets with really strong demand, but they're still seeing negative rent growth. I'll ask into a couple different parts. First, how has this supply that's been coming online really affected our current portfolio, different markets, and how we've been able to navigate?
So we have been insulated from it for the most part, with the exception, I think, of one market.
Yeah.
And that market is Bloomington.
Yeah.
I think Bloomington's the one market we've seen it. Like South Bend, our deal up in Granger Villas, there's not been a ton of supply. We kind of got delivered with all the supply up there that was being delivered kind of pre-2020.
Sure.
And
so there hasn't been anything delivered.
So there hasn't really been anything delivered since. And so we've kind of been able to grow rents there because there's not been new supply. Yeah. And so we've seen that there. Our other deal, kind of like nicer deal, is Sycamore Terrace. Sycamore Terrace, again, people aren't trying to go to Terre Haute and develop, but guess what? There's a casino that just went up right next door to our community. And so we've seen a lot of rent growth this past year because there have been jobs that, with that having opened, they brought in like a general manager. And I think that we have a handful of employees from there that move in right next door. And so we've had that. Our deal up in Michigan and Okemos, there was one phase that was delivered at an existing property that delivered. But other than that, there's been no new supply. And we've seen this past year, I think we saw 9% like GPR growth out there, or net rental income growth out there. Yeah. So like we've seen some areas and we're able to get some deals in some more supply constrained markets. But when we flip to stuff that we're looking at, the stuff that's is for sale is in those markets that are growing, because the developers developed it, they need to get out, or an owner doesn't have the money to put into a deal to renovate it, and it's been in a market that needs a renovation because the supply coming on is going to drive down their rents. And that's where it gets a little bit harder to pencil, because as it's coming on, as we just had that conversation with Katrina this morning, if people are developing, that's a good thing. Like,
it's a sign of demand.
It's a sign of demand.
Yeah.
But at the same time, it does hurt for a little while. I mean, we're seeing that, like we just talked about in Bloomington. Like,
tell us about Bloomington over the last year. Yeah, so we're kind of getting out of it, but
we're getting out of it, and it's been something we've grown with out there. I mean,
we love the market. We still like the market.
IU there's a lot of jobs. You got Cook, you've got Crane, you've got all of the things
this is Bloomington, Indiana, about an hour south of Indianapolis.
Yeah, so a lot of good things, and we kind of had a position there where we have two deals, not next door to each other, but not too far apart. Yeah. Both a little bit smaller though. Like one's 114 units, the other's 154 units. So obviously, as we talked about earlier, not the huge scale, and so we kind of operate them together, share some resources, which has helped a lot. But they're a little bit different, like asset types, because it's not like, oh, we can just rent 250 of Class A to everyone. I mean, Forest Ridge is a very nice but very workforce housing.
Yeah, there's solid B.
Yeah, no amenities, gorgeous units, but you have a parking lot and you have the buildings. That's about it.
Yeah, next it's near the interstate.
Yeah, it's convenient. It's got ones, twos, and threes. It's got anything anyone could want, but if you want amenities, it's not for you.
Yeah.
Echo Park, on the other hand, it's more of an urban style property.
Urban forest living.
Yeah, urban forest living. Has the amenities set. Has the studios, ones and twos. I think there are a couple threes there as well. Mm-hmm. But it kind of caters to the idea of student living because of how student living kind of drives where amenities are going to
Post
be.
undergrad, more grads. I mean, there are some
Grad
undergrads,
students.
but it's more grad students. You can't just work in Bloomington. Not targeted towards student, but it's kind of like a transition from student
Exactly.
housing.
It was amenitized to kind of entice students who had graduated and are still living in the area to be like, this is where you're either going to be when you're in grad school or like your young professional living arrangement in Indy. And there aren't many of those in Bloomington. But a couple of them delivered this past year.
Yeah, there weren't that many.
There weren't that many. And the big one was Hayden Flats, like a half mile away from us. And I don't even know if it's a half mile. It's across Walnut there.
Yeah, it's a stone's throw, quite literally.
And
or slingshot launch.
Slingshot launch is probably the best there. And it's right across Walnut from where we are, but 300 units and very, very nice amenity package.
It's brand new. Shiny new thing.
And so during lease up, when rents there they're just trying to get it leased up, it was a lot harder for us to pull people just because it's like our rents were so close. Maybe they were $50 ahead of us, maybe 100, but it was real easy for someone to say, hey, I'm just going to go over there for $100 more.
Yeah.
Now that they're full, all of a sudden they're not giving away the farm. They're now like $200 more than us. And we've seen a huge swing back, and now we're doing much better there.
Yeah, it does emphasize, some of the upside and potential risks of smaller, more secondary and tertiary markets. Of, you can be the only game in town or one of the few in town and be really, really successful, because it's kind of out of sight, out of mind. There's not as much competition. But if all of a sudden you get in the crosshairs of a couple developers and a ton of supply, you get floods on the market, it can really impact. First, if you're in a larger market, you're always dealing with a little bit of new competition, but there's more critical mass and potential renters to kind of absorb that.
And I think that's where it goes to, and I think you were talking about this when we kind of started the show of what do we look at. I think that's where it comes down to understanding how we're buying a property and what the basis is that we're buying it. Like Echo Park, I feel really good about that property. We struggled this past year, but I feel very, very good about that property.
Yeah.
We bought it for just over $170 a door. Yeah. You can't deliver new construction for less than $200 right now.
You know what that gets me excited for? We got new deals on the mind.
We have new deals on the mind. And so at that 170 a door, like I know no one come here. And it's like, we have the conversation all the time. It's like, well, you can say you're buying basis, but at the same time, if the numbers don't make sense, then the basis doesn't
relative
matter.
to what?
Yeah, exactly. And so it's like, yeah, they could be delivering for $230 a door, but if they're only getting $1,200 in rents, then they were just a bad developer and shouldn't have built that product.
Yeah.
And it doesn't make us any more valuable. And so, but when we're looking at markets where it's like, I know the developer's going there, I know there's a lot of demand, I know they're delivering for $240, $250 a door. And we know this because people have either approached us for equity or we've done our market research. So we know what those deliveries are. And then we see a property for $180,000. We have to really look at that deal and be like, okay, at some point this is going to recover. Can we get it from A to B so that way from B to C it's exponential growth?
And not only that, and just zooming out again, kind of like on the the 1% rule, we still have, I think it's 3.7 million housing units short in the United States. We've only chipped away at it was 3.8 million back in like 5 or 7 years ago.
Yeah,
we've chipped 100,000 units off of that.
Now, obviously, we've delivered a lot more. I mean, we're going to deliver like 600-some thousand units this year, but we've been growing the population. It's not like the population has been static. We've had a lot of immigration. We've had a lot of household formation. And so, and we'll just jump in again. Let's see if I don't know if they have a supply chart of upcoming supply, but we've talked about it a lot. Watch a previous episode. You can look at the chart, or honestly, just sign up for the Gray Capital newsletter, graycapitalllc.com. You can sign up for our newsletter that gets delivered to your inbox every Thursday at 8:30. We pack it full of all the latest research reports, everything related to the multifamily industry, commercial real estate, and the economy. But supply is going to start really declining kind of sometime in 2026. We're never sure because developers think they're going to be delivered, but they're not actually delivered. Maybe they deliver early. Sometimes it's a little bit extended. So it could trickle into late 2026, late 2027. But we're going to be at levels that we haven't, lowest levels that we haven't seen since like 2012, like post GFC levels. Now I'm sure that'll pick back up, but like the reality is we're at a huge housing deficit. And so when you're looking at just pure basis, you're talking about sub 200K a door, when we know that it's going to be costing minimum that, if not up to 230, 260 to deliver, depending on the market. And
the
assets
style of product.
For similar, the same or better product. And in the last peak cycle, assets were trading for 300 plus a unit. I think the average per unit multifamily sale price at peak ZIRP pricing was a little over 300K a unit. So we're not there again right now, but based on cost of construction, labor costs, it's not though we can go down so much further. And with a lack of supply, I don't see a scenario where we aren't back at that level in the next couple of years. Again, is it end of 26? Is it halfway through 2027? And it comes back to, I think, the investment strategy that we have followed since day one is taking a long-term approach and not thinking that we can time anything other than we know if we just don't know the when. And if we can give ourselves 5, 7, 10 years, I think that we're going to be right. But if it needs to happen in 2 years or 3 years,
that's a lot harder.
That's just a lot harder of decision to make. And again, this is where Jay, you and I all the time, like we know we're not making. We look at some of these assets that even like today look to be overpriced. We can look at each other, and if we had $50 million of equity just in our pocket, we know it wouldn't be a bad decision. Is it the most efficient investment? Maybe not. That's why we're going to keep looking for more, and our investors, have a high bar of what they're looking for. But we know some of these assets and some of these locations, the cash flow doesn't look that good, but we know in 5, 7, and 10 years the price is going to explode. It's a little bit of uncertain, all the details.
Well, yeah, and I know there's a deal that you and I are looking at right now that it's like we've seen some stuff trade in the area, and so we kind of know what that is. We know what the rents are. We know that there's definitely supply coming on in the market. Like we are aware of that, but there are some factors that like there's a lot you can ride out in that market, and if you buy it right into the right location, you can make a deal that other people maybe trying to buy in the same market aren't going to be able to do.
Yeah.
And I think those are the opportunities. And that's I think what we've been trying to do. It's like, hey, really kind of mix in that story and be like, hey, this is why this one matters. This is why, like when they say location matters, it's like, hey, your cash flow is going to look a little bit rough here, but this property sold for XYZ. So we're buying relative to the market, but this is why we're going to outperform all of those.
Yeah. I think that the underwriting the numbers, because we know it's not going to look great right now in today's environment, but we're not at a point, and I don't think anyone should ever be at a point of where it's like, well, the numbers don't matter. I know that prices are going to go up, so we just need to buy at whatever today. Because I know a lot of folks that kind of didn't do that exactly or that haphazardly, but did overpay, or they built at a basis that was too high relative to where the market is today. But if you are going after a deal and the assumptions are reasonable, not overly conservative, not overly aggressive, but just reasonable assumptions, and the returns are acceptable, lower probability of losing money, much higher probability of getting some cash flow and some appreciation. It's not going to look like a home run. I think those are the deals that will look like home runs. That is to the core of what I believe. It's just, we're not going to put all of those numbers in a pro forma.
Yeah, and spoiler alert for any of the people that are looking at investment thesis, you're probably not going to see a 19 or 20 IRR deal from us that we're going to put out there.
Yeah.
Because we think maybe the deal could be a 19 or a 20 IRR, but we're trying to look at that risk and we're trying to assume it. And if you do see a 19 or 20 IRR, believe we probably internally think it's more like a 25 IRR.
Yeah.
And so I think that's where we're looking at right now is I've kind of told you for the last however long is like, I want to, as we mature as a company, I really want to raise our floor. Everyone kind of has that great blow out the ceiling type deal, but I really want to raise our floor of like, the downside is not zero, but as close to zero as possible. And I think
there's always going to be risk, but yeah, you try to protect that downside as much as possible.
And I think that's where I would say I remember 2.5 years ago, you came on and had a message to our investors of like, this is how we are going to operate. And it's like, we preserve your capital above all else.
Yeah.
And I think taking that strategy, am I a broker's best friend at times? No.
No, but we whittled them down over a year, and they finally were like, okay, all right, yeah, the number that you sent that I laughed in your face at, yeah, okay, yeah, that is probably the number. I mean, there was a lot of that,
yeah.
and it was like, look, we're 30% below what they want, and we're so far away, and some of it is like, well, they're going to lose money at that price. And it's like, well, that's what the value is. And no one wants to have that conversation.
Yeah.
No one wants to go to their client who they've been getting them excited because their stale BOV, shows that they're going to get a decent return, but that's just, Fugazi doesn't exist anymore. And a lot of the equity is just poof, gone. Have to kind of rest with the reality. I think there's a lot of folks that are they're kind of confusing labor theory of value with utility value theory. They think that well, we put all the work in, this is what we developed for, that's what it should be worth, versus, well, what is the market value?
And I think that's one of the things, the conversations you and I have had a lot lately is so much of the value of real estate in 2021 and into 2022, it was financial products. This real estate was treated as a financial product, and it's just not.
Wow.
Because I remember there was a deal here in Indiana that we looked at. Very tertiary market, very tertiary market. And it was close to some stuff that we owned. So we liked it. We wanted to go after it. And we put in a reasonable offer at good returns and a reasonable rate. But I think it sold for well north of $200 a door, in a market that you could probably buy a house for $200,000 in.
Yeah.
And the only reason it was a loan assumption that had a 3% interest rate. So you could get a 8% cash on cash return on it.
Yeah.
But then as soon as it expired, you had to sell it for almost $300 a door.
But isn't, especially commercial real estate, they are financial products to a degree. I mean, yeah, they're more than financial products, but just like homes are financial products and a home, they're a financial product not only to, for the person who owns that mortgage, but then, the companies that are, creating those MBS, pools as well. And same thing with multifamily, whether it's the MBS pools of commercial mortgages, or, the REITs, or the private equity shops, or everyone else that is, the pref equity, firms. There is that financial product that exists.
I think that it exists, but I think the thing that's different.
And isn't that what's driving it though?
Some of it's driving it. I think the residuals and allowing you to make the money off of it is what is, because no one would take the risk to build it if you couldn't make some money off of it. But I think the difference where I would talk about it is securities is the operational risk. You don't necessarily have that operational risk on another financial product.
Well, well. Some do. Some, they're operating businesses, right? And so it's same with buying a stock. And what I agree with what you're saying, but I guess with a caveat of that, I think it's both. And same thing with the public markets is that there's a pure financial product side, and then there's where the rubber meets the road and boots are on the ground. And those two often can be greatly divorced, of where you can live in spreadsheets and you can just live in CoStar and spreadsheets, and that's it, and PDFs, and there's no real physical real estate in pools of properties. Or you can be boots on the ground, turning units and getting leases happen, and looking at the bottom line and seeing what you have to do to get a prospect in the door, to what's the quality of that housing unit, is it clean, is it nice, is it in good condition. And there's different players operating in those different spaces, and they have different perspectives, and that's why I love doing what we're doing, is because I think we both came from, especially me, but more on the financial product side, or just looking at it from a finance, an investment, and looking at it from spreadsheets, and over time wanted to learn more and more and more about actually how is all this done? How do we get work orders done? How do we sign leases? How to affect change? And where, you were, asset management. And so, you were a little bit of both, but probably still more on like the financial side than, you were on the property management side.
Yeah.
But now, we've started a property management company a couple of years ago, and seeing where, especially in this environment where operations can be the game changer, because we've seen the difference between, competent management or manager and incompetent management or management company or individuals. And it has a profound effect on everything from the actual conditions and the quality of the living experience to the results of the financial product. And some of the folks that only focus on the financial product cannot go downstream far enough to understand that.
And I think that's probably where the divergence is. And I would agree with you. And that's why I think when we look at it combined, yes, you're 100% right. It is a financial product. The problem is, like, I can't think of it as 100% financial product, whereas someone who's trying to sell the arbitrage on a 3% mortgage rate and selling it for a 5 cap, that's all they're doing in a tertiary market. And it's the same reason that, while it's kind of disappeared some in the last few years, it used to be like New York, that's a 5 cap. Texas, that's a 6 cap. Indiana, that's a 7. Some cities in Indiana, you might be an 8 cap.
Yeah, 100%.
And that arbitrage doesn't really exist anymore for location.
It's much tighter.
And it's much tighter. And that's where I think some stuff is getting lost, where you should, I may give away the product here. In central Indiana, northern city of less than 40,000 people, you can't sell a 5 cap.
Like Hamlin County. Yeah, Hamlin County. Yeah, a deal's not selling for a 5 cap.
Yeah,
it's selling below. It's going for a
but then like the place that has 40,000 people should probably be a 6 or a 7 cap, because
depending on
some of the market forces.
Yeah, in the prospects for growth and incomes and all of that.
And who's going to buy it if I want to sell it?
Yeah. Who's the buyer at the end of the day? All right, I want to just take through, and we're not going to get all these articles, folks. I'm sorry if there was one article that you're really looking forward to us talking about. We'll probably talk about it on the next episode when Dr. Boston comes back. But I do want to just look at apartment lists, just kind of maybe get your take, Jay, on just some of these, some of the kind of fundamentals of where we're at. And I'm hopping on with Marcus and Millichap later today to do a 2025 multifamily outlook. And So I'm curious on your outlook for the future as well. Median rent in the United States was $1,382 November 2024. I'm going to go down to this kind of month by month bar chart. Looks like we just didn't have the peak growth that we typically see in the peak leasing seasons, kind of late spring and summer, and we're seeing some of more normal, but even maybe a little bit more exaggerated slowdowns, seasonal slowdowns that we would expect in the colder months after everyone's in school. Any thoughts for 2025 next year? 2024 kind of looked very similar to 2023. 2019 is kind of the way we would like it to look, where we're seeing a lot more growth in that peak leasing season and then just slight declines at the end of the year. Do we got one more of these just tepid, slow growth years like we've had this last year and the last, or are we going to go back to kind of like a 2019? And do you think we'll ever see, maybe not like a year like 2021, but how about like 2022, where we actually saw some really strong growth? Is that a possibility at any point, maybe when supply drops down? I don't know. What do you think?
I don't think we'll ever see a 2020. I think we could potentially see a 2022. I think when I kind of wrap my head around this, I have to think back to a data point that you and I both have. Maybe you remember this comment, maybe you don't. I remember you and I were touring a deal with Hannah Ott sometime in 2020. And I remember her saying, it was as they were giving the stimulus checks. And I remember her saying the average 2-bedroom in the Indianapolis metro was $900, which was a fraction of what those stimulus checks were. And she's like, that's why we don't have bad debt.
Oh yeah, I remember when 850 was the average 2-bedroom. I feel like for the longest time.
And so you and I just had a conversation. We were talking about in our asset management meeting this morning. It's like, what number of properties in our entire portfolio do we even have 1-beds that are below 1,000 anymore?
A small handful. We've got, down at River Club, there's probably a handful.
I think there's about 900. I think Suncrest is like 950, something like that. Mm-hmm. Yeah. And so now we're looking at 1-beds 3 years ago or 4 years ago, I guess, where
We're talking about leasing unit villas for $3,000.
Yeah. And so I think where I struggle is thinking about those raw numbers of like, how can we see that kind of growth again in a 4-year span? Like,
Yeah.
it's just, it would be so hard for me to wrap my head around seeing that kind of growth again. Now, the drivers for that, like you said, are the reduced supply that's coming. And if we are able to bolster the economy, I know we've had some conversations internally with like the Department of Government Efficiency. And because we work with like HUD and some of the other GSEs, like, how is that going to affect and change our business at all?
Yeah.
But so if they're able to accomplish the goal and what they say they're going to, and it does boost our economy, but we have this low supply of housing, what does that kind of growth look like?
Yeah, it's all really good points. And I agree. I don't think 2021 really brought forward so much. It caught some demand up, and then it also pulled some demand forward.
Yeah.
I don't think we can see this type of dramatic. I mean, this is like 20-30% rent growth in a year in some markets. But I can see once the supply really slows down into 26 and 27, at least above trend growth.
I would think
this
5 to
growth is
7.
like spread out over a couple of years.
I could see 5 to 7 for a couple of years, like
in
on
some
annual
select markets. Yeah.
And I think that's just going to be like, I think where we've looked as we always look at jobs and we look kind of see what it is. Well, a lot of the markets that we're looking at, like we look in Ohio, we look in Indiana, we look in Michigan, we look in Louisville. Well, what's been announced in those markets?
Yeah.
Well, here in Indianapolis, you have the LEAP district.
Mm-hmm.
So we know those projects. Well, those projects take 3 to 5 years to deliver.
Yeah.
So we kind of know what the job growth is
Mm-hmm.
moving forward, at least in those specific areas. There are other ancillary stuff that can come up and kind of go. Columbus, you have, what is it, the Intel or the Dell that was announced. Well, you and I were looking at that chart earlier. And so like Columbus's peak supply is going to be later on because everyone saw that delivery and is kind of pushing out. And so once we kind of, and the markets we're at, we kind of know what that's going to be. It's not like all of a sudden, like we're not the Seattle, Washington, where, or even the San Francisco Bay, where's the next tech company that's going to explode and have people that can pay and they are growing. It's like to grow here, it's usually one of those manufacturing jobs, a large kind of headquarters that takes 3 to 4 years to build.
Yeah. And then the critical mass, I mean, of the ancillary jobs and industries that kind of build up around it. But take a decade or more to really kind of fulfill what that looks like. I mean, and even a longer period of time. I'm talking about the LEAP district. I mean, there will be things done. I mean, they're making a ton of progress up there on the Lilly facilities. I drive by it just about once a week. I'm going to drive by it here this afternoon. They still have a lot of work to do. And then, like Meta was announced. I mean, they're thinking about building a $1 billion facility up there as well, data center. That may not have that many jobs, but there's other. I mean, it's a ton of construction jobs in the short term. And again, there's ancillary businesses, and you're already seeing it in a town like Lebanon. You're seeing more. You're seeing housing exploding. You're seeing more retail, a lot of newer retail, and so those are all these jobs that are kind of getting ahead of it. But you won't really see the full impact for years to come.
And I think that's where, like you said, I think we'll see some good growth, but it's going to be tempered because it takes so long for that stuff to deliver. It's like, well, this delivers, so I can grow 5% because we haven't caught up with that. And critical mass would be like a 10 to 15% rent growth, but because of the way that it delivers in markets like Indianapolis and Columbus. I mean, down in Louisville, you have the River Ridge stuff going on the Indiana side of the border. Up in Michigan, you have all the redevelopment of everything that's going on outside of Detroit. And so, I mean, we've looked at stuff kind of in the suburbs of Detroit and seen, wow, like you think of Detroit and you think kind of have a bad connotation, and then you see the growth in kind of those suburban corridors out there. And it's like, holy cow, like stuff's delivering. It's going to take a while, but like there's a path here.
Yeah. And I think also on that point of suburban growth, I think that's just a trend that's also going to just continue over the next 10 or 15 years. I think the urban cores are going to be like fine, but I think all the new growth, exciting growth is still going to be in the suburbs. Just people looking for more space. There's just not really as much room to grow in the urban core, and people just want, again, just a little bit more space. Just on affordability, because again, it's like, all right, we can't squeeze too much blood out of a turnip. Fortunately, rent to income ratios, surprisingly, because everyone's like rent's really high, and it is high. Not as high, relative to buying a home, but fortunately, wages have been growing. This is according to Moody's, the national median household income rose 3.6 year over year, easing the rent to income ratio, which actually declined to 26.3% 7%. About 30% is considered rent burdened, according to most. And so, if you look at, again, rent to income ratio is on the decline. It kind of peaked up here at a little just under 30%, 29% ish. And it has been on a steady decline as income growth has peaked. Now it's leveled off. It really kind of peaked in 2023. And rent growth around the same time has also come down. Rent growth was, again, crazy, 15, 16% for a year. It's come down. And so that would allow, some rent movement, but we're also doing a little bit of catch up too. I think some people were having to sign leases at rents much higher than they.
Yeah. And I think we saw that in like we've talked about and what we track internally with our bad debt of like, I think we were really good in 21.
Yeah.
Even into 22, we started to see the cracks in 23. Yeah. We realized that 21 and 22 got really aggressive.
Yeah.
And fortunately, we've been able to notice it and stay out ahead of it on our deals. But I do think that rent to income ratio, I don't know that maybe allows the rent growth that we think, but I think it may preserve the back end of delinquency a little bit better.
Yeah. Yeah. I think that makes sense. All right. Any closing remarks? Any last words?
Thanks for having me on.
Absolutely. Got to come back on. This was a really good conversation. Again, if you'd like to learn more about Great Capital, what we do, hop on over to the website, greatcapitalllc.com. We do offer investment opportunities for accredited investors only. But whether you're accredited investor, non-accredited, you're in the industry, just want to learn more, again, sign up for the newsletter. It's on the website, greatcapitalllc.com. And if you're not subscribed to the Great Capital YouTube channel, make sure you do that right away. You're already on YouTube, so you might as well just click the button. If you're not on YouTube, if you're on Spotify, well, you just have to do it when you've got the time. But thanks again. Reach out. Again, we've got a lot of more interesting content going to be coming out. We're going to have kind of a 2025, our own Outlook webinar that will be announced shortly. We've got another research report that we're going to release shortly. So all kinds of good content coming out from Great Capital, and maybe even a deal in early 2025, January. That's what we're hoping for. So again, if you're a accredited investor, stay tuned. You want to be one of the first that gets on the list, because this deal that I'm thinking about, it's not going to be a massive equity raise for us. And we've got folks that are like, hey, I've got $4 million, $6 million, $2 million. So it's going to go pretty quick. So if you haven't gotten in touch with us and you haven't booked a meeting with myself, Blake, or Griffin, do that right away. Again, so you're just in the queue. We've got a short list. Just reach out. Make sure you're on the short list. Okay. Thanks again. Have a great week. Catch you on the next episode of The Great Report.